Good evening, class, and welcome to our advanced taxation lecture for today. We are treating the topic capital allowances. This is part 3 of this topic of capital allowances. In part 1, we learned about what capital allowances are. We learned what is initial allowance, annual allowance, investment allowance, rural investment allowance. Then we got to see the restrictions on capital allowances. It only affects those that are not into manufacturing and agriculture. So any company that is not into these gets restricted to 2/3 of their accessible profits. Then we now saw some questions where these capital allowances were not restricted. So we saw questions that has to do with an agricultural company. Then we went ahead in part 2 to look at calculating capital allowances when we have higher purchase. When we have higher purchase, how is capital allowances being calculated? We saw that we have to look for the capital payments in all the installments, and we added them to the initial deposits. And so we need to know how many periods that was involved in the hire purchase agreement, and we need to know the year, the accounting year end date, so that all the capital payments between the date when it was when the asset starts the hire purchase to the date of the account year end, we need to check how much capital payments has been made. Then we need to find the capital allowances on them. We saw 3 steps formula, how to extract the first one was higher charge, how to get the higher charge per month. Second one was how to get the capital payments in each installment, and the third one was the total capital payments for the period. Then we looked at how balancing charge and balancing allowances were treated. We looked at that a little, and we said today we are going to be doing something called carryback of capital allowances. So, what is carryback of capital allowances? Like the name suggests, capital allowances can be carried backward. Normally, business move forward, and by that, whenever you have an unutilized capital allowances, you move them forward to the next assessment year. The same thing with your losses. When you have loss on a particular year of assessment, you take it to the next assessable year. Why? Because you have the hope that because your business is ongoing, going concern, you will one day get profit that would clear your losses that you have been accumulating. And as it is clearing your losses that you have been accumulating, it's your prayer that you will also have sufficient accessible profits after the losses have been cleared to clear your capital allowance. And so anyone, any accessible profit that can do that, or that can take part of that, you keep taking them forward, and you have your unutilized capital allowances. You have been taking them forward, taking them forward. Now you come to cessation of business. When your business ceases, when there's a cessation of business, the cessation rule applies. And when it applies, any loss that you are carrying forward, or any loss that occurred in the cessation year, what happened to it? It is lost forever. What about capital allowances that you cannot recoup? What happens to it? Capital allowances in the year of cessation that you can't recoup, you can't carry forward, because the business is not moving forward. The business is ending. So what do? You carry them backward. Why? Because capital allowances are a way that government is repaying you back for the investment in your assets. And so that's why you are claiming capital allowances, to recoup the assets investment you've made. But in the year of cessation, there's no way you can recoup it. And the government is saying, all right, take it backward, and in place of the tax, that you have paid, use it to recoup your capital allowances. So it means that you are going to be refunded all the taxes for last year, and you are going to clear your capital allowances for last year. Now, if the amount of capital allowances is too much that it cannot be cleared for last year, take it to the year before last. They will refund you your tax, and you also clear your capital allowances. It is possible that last year or the year before last cannot clear the capital allowances. Take it back again. That is how you'll be doing it for a maximum period of 5 years. Now, what it means here is that if this is 2024, you need to take it backward to 2023, 2022, 2021, 2020, and 2019. That's the last. Now, if in 2019 the capital allowances cannot be recouped, then it is deemed to be lost forever. So the law says here that capital allowances will have to be carried backward for a maximum period of 5 years, beginning from the year before cessation. Carry them backward for 5 years, and if you cannot carry them, if you cannot utilize them for that 5-year period, the unutilized part is lost forever. Now, this is different from profits or from losses. Any loss you have in the cessation year is lost forever. It's lost forever. So it's better not to have loss in the cessation year. It's better to clear your loss and have unutilized capital allowances in that year, because the year of cessation is a deciding year. Your loss gets lost, your capital allowances gets carried backward for 5 years, and after that, if it is not cleared, it is lost forever. All the taxes in those periods that you have been carrying back will be refunded to you. The big question is, how do we carry back capital allowances? How do we treat it? An example will help amplify what I am saying. We now go to question number 1. This is skills level November 2015 tax question. You are a professional, yes, and this is a skills question because these questions cannot be found in professional level. Most times, it is skills level that you get to do most of these things. But in your professional level, it is possible that you may have to apply the knowledge of carry back. You may be in a position to advise a company, write a memo, and advise them on what to do. And you may be surprised that you will be dealing with carry back. It's possible. And I said before, capital allowance questions are always time consuming. And now, this is a question number 1 type of question. How do we deal with this? Let's read. It says here, Quick Fix Limited deals in the sale of sweet milk brand of drink. The company commenced business on May 1, 2000. Now, due to the prohibitive cost of doing business in Nigeria, it decided to cease business on July 1, 2012. The following information were extracted from its record. Now look at from 2017. So let's count. This is 1, this is 2, this is 3, this is 4, this is 5, this is 6 years. They gave us about 6 years assessable profit, year of assessment. Now we have a loss here, assessable loss. Look at the capital allowances here. Look at the total profit. Of course, there will be no total profit and there will be no tax paid because you have a loss. In the next year, you have an assessable profit. Look at the capital allowances, look at your profits, your total profit, and look at your tax. Someone is asking, someone is saying that we can't hear you clearly. If you can't hear me clearly, please, is there another person that cannot hear me clearly? Please, can you indicate now? If you can't hear me clearly, can you indicate? If you can hear me clearly also, can you indicate? Okay, so someone said, I can hear you. So it's a network issue. All right. So let's go. Let's test something here. Look at total profit here. 1,314,000. This is your total profit, right? That's this one here. If I were to look for 30% of it, which is 0.3, I am to get 394,200, which is this. Now that's confirmed. Now there's something I want to show you here. If you are giving your tax paid, and you want I had a call, so I'll share my screen now so that we can see. Okay, I was about showing you something. In the first instance, I did something like this. I said one one three 131400 131400 multiplied by 0.3 gave us our tax payable. Now if you want to go from here, tax paid to total profit, all you need to do is to divide your tax by 0.3. That will give you your total profit. I want you to remember this conversion principle as we are going to use it in this question. All right? So the same applies to all of these. All right? Now, we are told that the company made a claim for unutilized capital allowances to be carried back. During the period January 1 to June 30, the adjusted loss of the company was 1614500. Capital allowances due was 2561250. All right? And we said during the year when a loss occur, or when the year of assessment of a cessation of business is determined on the date that the cessation tax is due. And we said that if the business ceased in between January 1 to June 30, the year of cessation will also be in the same year. Okay? So that's the same thing we have here. And now, look at what the tax computation with the FIRS was agreed on. Look at the year 2017. We had a loss, which is this loss here, and this. Look at the capital allowance here, which is capital allowance carried forward. Then we have accessible profit of this one here, which happens to be this. Then these are the losses brought forward. We brought this loss forward, and when we try to relieve it, it gives us this, because this here is accessible profit, and you brought your loss forward. That means this profit deducted this loss will give us a profit of this magnitude. And look at your capital allowances. The one you brought forward from the last year was this, which happens to be this. Then the current year happens to be this one here. Okay? And we got this. And it was restricted to third, which gives us this figure here, and which we carried here. So your capital allowances for the year happen to be 1347067. That's the capital allowance for the year, total claimable. But this is what was incurred for just that year. So, but this figure here includes the one that was carried from last year, the one that was brought this year, and this is the restricted amount. So this is the restricted amount that you carried here, and this is the unrestricted one. This is the balance that you cannot clear. Your total profit happens to be this. Your total profit happens to be that. It's not written down here like that. Total profit happens to be this, and your income tax was 20260. It's not jiving with this. So there's a need for you to check. There's a need for you to check whether these things here also correspond with these ones here. Okay? So since it is not corresponding, this is the capital allowance brought forward. This is the current year, 4168500. Let's check. That's it here. Your total profit happens to be 3067250. Let's see. 302. This one is correct. So what we'll do, we'll be taking it from here. Then in 2010, we have accessible profits. We have capital allowances brought forward, capital allowance for the year, total capital allowances restricted to third. So 2/3 of 13, no, 2/3 of 7,581. Let's do it one. Let's do one of it so that we'll see what we are saying. We have a capital allowance of 13,808,383. And we have accessible profit of 7,581,750. Of course, we cannot pay a debt of 30 million from 7 million. The law says that the debt that you can pay must be 2/3. Just like you want to go and take a loan, and the bank is telling you that you need to look at your pay slip, and your loan that you'll be taking, your payment plan must not exceed 2/3 of your pay slip for a year, of a month. So it means that if you want to make your payment period to be 12 months, look at your pay slip, look at 2/3 of your salary, multiplied by 12. That is the maximum loan you can take. Using that analogy now, you want capital allowances to be cleared. You have 7,581,750. You look at 2/3 of it. So we say 2 divided by 3 times 7,581,750. And that gives us this 5,054,500, which is what is claimable. And so we go. This is the capital allowance for unutilized, which will be carried forward. All right. Now look at the tax that they paid, 758. We go to this year and look at the capital allowances you brought down. Then you have the current one. You restricted it, of course, which is going to be 2/3 of its 11 million. You're able to pay 7 million, and you take 10 million to the next year. And when you came to this next year, you have accessible profit of 4,666,000 to 664,375. Right? Then you have capital allowances here brought for the year. It becomes 14 million. But when you look up to third of 4 million, you have 1.399, which is what is claimable. And you have your tax payable is 979,519. All right. And now you have issues with your 2013. In 2013, we are told that the adjusted loss for the company was this, right? The adjusted loss is lost forever. So what I will do now here, we are asked here as the Chief Inspectorate of Taxes, so you are working for the government, compute a revised assessment of quick fixed limited on cessation basis, taking into account unutilized capital allowances. Then we are asked to determine the tax refundable by the FROS for the relevant years of assessment. So how do we treat this? How do we treat this? This is quick fix. Quick fixed Nigeria Limited. All right, so you are going to do, what's the requirement? Revise assessment for the relevant years of assessment. Revised assessment for year of assessment. We have to count from 2013 backward. So we have 2012, 2011, 2010, 29, 28. 2008 to 2012. You see clearly why I am doing 28 to 2012. But what do we do? We'll be doing them backward. So we start with year of assessment. Okay, supposed to be up to 2013. 2013. 2013. Forget about the basis period. We are told that accessible loss. What is our accessible loss here? We are told that the loss accessible loss is 1614500. 1614500. So this is our naira sign here. 1614500. That's your loss. So you say accessible loss lapsed on cessation. So this is lapsed. You can't recover it. Then this is unutilized capital allowance to be carried back. What is our capital allowance here? Capital allowance 2,561,250. 2,561,250. So this is the capital allowance that will be carried backward. So of course, your total profit will be nil, and your company income tax at 30% will also be nil. Let's forget about education tax. So we now come to the year of assessment 2012. What do we know about year of assessment 2012? What do we know about it? Look at 2012. In 2012, we had a total profit of this, right? Okay. Now, if you look at, um, hold on a moment. Let me take this one up here. Total profit, let's check something here. Total profit was here, 155. So, and tax paid is 466,343. That is what they claim from their record. But look at this. Tax payable was this. So this is what we'll be taking. We look at the total profit first. The total profit is 3265. 3265062. You say total profit brought down 2326. If I am correct, 3265. Sorry, 3265062. 3265. 3265062. Now that's your total profit brought down. Then you need to bring your total profit carried forward. So now if you look at this now, you pay the tax. This is your profit before your tax, right? This is the profit you had before your tax. It is from this profit, this total profit, that you paid this tax, right? So you are going to be refunded this tax. Another way of doing this thing here is to have done it this way. If we decide that we say 979,519 divided by 0.3, we would have gotten the same thing we have here. So instead of going through that long process, go to the total profit that you have before your tax was computed, and you bring it in here. So this is your total profit brought down. So instead of charging tax again, what are you doing? You are going to do something different. You will not say capital allowance brought backward. Of course, we had a capital allowance here before. It has been cleared. That's what gave us this total profit. So you don't come and say, okay, with that one you are carrying backward, will you come and join the one you have done before? No. That one you've done before gave you a total profit which you are working with now. So you don't talk about the ones that you've done before. That one has been done and cleared. And it is this unutilized that leads to that one that we have, that we are carrying backward. So we don't talk about capital allowances. What we start from is total profits just before the tax. So we have capital allowances carried backward. We have it as 2,561,250. I'll write it down here. 2,561,250. So these are your capital allowances that you carried backward. Now, can you claim it? Just a moment. All right, so sorry for that break. is the capital allowances carried backward from this year. This is the capital allowance for that year. There is a capital allowance here which is unutilized. I should have adjusted this. I should have adjusted this one here. So let me adjust that now. I should have adjusted this. So let me just do the adjustment here. Okay, so this is the capital allowance for the year. That is what I should have called it. Capital allowance for the year. Capital allowance for year. The capital allowance for the year, how much was that? Was given to us here. Sorry. Capital allowance for the year 2561250. Let me call it 2561250. Okay. Then this is the capital allowance that is supposed to be carried forward. 12,892, 12,892,570, 12,892,570. So I will say 12,892,570. So this is capital allowance brought forward. So when you add them together, let's say 2561250. That's the one for the year, plus the one brought forward, 12,892,570. That gives me 15,453,820. 15,453,820. So this is the capital allowance unutilized. So this is what I'm going to be carrying backward. So that's the figure I'm going to carry backward. Because normally this capital allowance was supposed to be carried forward, but because it's a cessation year, you can't go forward, you are taking it back. So this is the capital allowances that you are bringing backward. 15,453,820. Now, whether the company is supposed to be having 2/3 restriction or not, in carrying backward, you don't do restriction on capital allowance. No. What you rather do is the capital allowance that you are going to carry backward, that you are going to claim. Look at it now. Capital allowance claimable. Capital allowance claimable is going to be, look at the tax that you paid. You're supposed to be refunded this tax, isn't it? 979,519. You simply say 979,519. Is that it? 579,519. Now you say divided by 0.3. Of course, we did it before we got this figure. So it means that this is the figure 233265062. This is what you are going to claim. So instead of doing this, just simply look at this figure here and check, is it bigger or smaller than this? Can it be claimed? So here, we're also going to do the same thing here. 3265062. So what happened here? This is the unutilized now that you are going to calculate the new unutilized. You have 15,453,820. Let's minus 3265062. Now you have 12,188,758. Now this is the unutilized carried backward. So this will now become total profit. So the essence now is to make your total profit to become nil. Let's write nil here. Your total profit will now be nil. So you see here, you had a total profit of 3,265,000 before, and now you have paid, you have been refunded your tax so that you can claim capital allowance. So the tax is 30% of your total profit. When you divide it, you are going to get your total profit. So it's as good as taking all your total profits as the amount of tax to be, amount of capital allowance to be claimable. So it means your total profit will not be the maximum tax claimable capital allowance for the carry back for that year. So you have a total profit of nil, and your CIT will be nil. So when CIT is nil, you will now say CIT refund. CIT refund will be, they're going to refund whatever that was taken before. So this is the CIT refund. So the FRS is going to give you this amount, and you are going to claim more capital allowance. So this is for the first carry back. So I will come here, I will say first carry back of capital allowance. I will go to year 2011. Let me do 2011 here. Year of assessment 2011. And I will say this is the second carry back of capital allowance. So what do I need to do? Total profit. In total profit, I'll just go for what was done in 2011. This is the total profit here. 3,860,250. 3,860,250. 3,860,250. That's your total profit. So you will say capital allowance brought backward. How much are we bringing backward? We are bringing 12,188,758. 12,188,758. Okay, so that's the allowance brought backward. So capital allowance claimable. Your capital allowance claimable will be 3,860,250. 3,860,250. So when we remove this, we have 12,118,750. So we remove 3,860,250. That gives us 8,328,508. 8,328,508. So this is unutilized capital allowance carried backward. The next year or the year before it, it will not be brought backward. So this is what we are going to carry backward. Then our total profit will now be nil. So I will say CIT nil. Then you need to come here, CIT refund. We'll go down here and bring this amount 1,158,705. Sorry, 075. 1,158,075. So this amount you are going to be refunded. The tax is nil. You now go to the next carried back. We've just done 2011. So we'll go down here to year of assessment 2010. Third year of carry back of capital allowance. You have your total profit. For 2010, what's the total profit? You're going backward again. The total profit happens to be 2,527,250. 2,527,250. That's the total profit. Then this is capital allowance brought backward. So that's carried backward. It's now being brought backward. 8,328,508. 8,328,508. So capital allowance claimable. Can only claim as much as your accessible profits can carry. 2,527,250. You cannot claim more than your capital, than your accessible profits. In fact, you should aim to claim everything in your accessible profits. except if your assessable profit is bigger than the capital allowance. So your capital allowance carried backward. So how much is this going to be? We're going to remove 2,527,250. That will give us 5,801,258. So your total profit, so you have now the second total profit is now going to be nil. That's the essence, to convert this total profit from what it has to be here to nil, and you get a refund. So your tax, CIT, will also be nil. So your CIT refund will be any CIT that was paid in that year. 758,175. 758,175. Write this well. 758,175. Then we'll go to the fourth year, which is 2009. Year of assessment, 2009. Fourth year of carry back of capital allowances. Let me be sure it is 29 years, 2009. That's going to be the fourth year. So what do? Go to 2009, and we were going to look at the total profit here, 3,067,250. Let me write the figure, 3,067,250. Okay, all right. So that's going to be our total profit. All right. Then we are going to say capital allowance brought backward. We will now go to our capital allowance carried backward. How much is it now? 5,801,258. Then capital allowance claimable is going to be not more than your assessable profit, or your total profit rather, 250. Then this is your capital allowance carried backward. How much is it going to be? Bring our calculator. We're going to remove 3,067,250. It gives us 2,734 and 8. 2,734.8. Then of course, the new total profit will now be nil. Of course, your CIT will be nil, and your CIT refund for the company, how much is it going to be refunded? We are going to refund them 920 175. 920 175. 920 175. Okay, so we have 28 now, year of assessment. 28. You say fifth and final year for carryback. For carryback. Fifth and final year for carryback of capital allowance. So you have your total profit here. Your total profit, how much is it? 3 billion, 3 billion 67. Is it 29 we are doing? 28, sorry. Because I was looking at we have done that. 28. So your total profit here will be 673, 673 533. 673 533. That's your total profit. Then you have your capital allowance brought backward. 2734008. So what do? Capital allowance claimable is going to give you 673 533. Same thing here, 673 533. So let's find out the difference. Let's remove 673 533. You have 2060 475. Is it 475 or 457? 475. Beg your pardon. 475. What do we call this? Capital allowance lapsed. Open a bracket, forfeited. So this is the amount of capital allowance you are forfeiting. And so your total profit going to give you nil. Your CIT is still going to give you nil. Then your CIT refund. Your CIT refund will give you 202,060. So this is what you are going to do. So remember we said 2008 to 2012. I have 2013, but we are saying revised. We are revising for 212, 211, 10, 9, and 8. You could as well make it up to 2013 if you want to, but this is revised. Revised is, this is the year that you were in, that you were revising it, is in the year of assessment 2013. But you're not revising that of 2013, you are revising that of 2012. So what you are going to do here is to now bring a summary of revised assessment. You can arrange them in descending order if you want. You can say this is year of assessment, and I can say, let me write my 2013, 2012, 2011, 2010, 29, and 28. So, of course, my total profit in all these years will be nil. So I don't need to put total profit. I can decide to put total profit, all right? Total profit, this is nil, 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 and nil. I can say CIT payable is still nil, 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 and nil. CIT refundable. So we start by going 28 is 20260, 20260, 202060. You can go to 229, 920, 175. For 2010, 758, 175. For 2011, 1158, 075. For 2012, 979, 519. And for 2013, of course, you didn't pay tax. There will be no tax refunded. So you see here, These are the 5 years you carried backward. It's these 5 years. 1, 2, 3, 4, 5. For the year 27, it was just given to you to see whether you will go and use it. For some people, they will go and use it, but you are not supposed to go to 27. Even at that, in 27, you have a loss. So you didn't even have a capital allowance. 27 year of assessment will not be revised. You're only going to be doing as much as 5 years backward. So that's how we do carry backward of capital allowance. So I can come here and say, capital allowance lost, which is lapsed. I can come here. When I get to this point here, how much did we calculate as lost? 2064.75. So this is the capital allowance that was lost. So this is the capital allowance that was lost. So if you look at it now, you have arranged your answers in this manner. Year of assessment, you don't need assessable profit is now our business. Total profit is our business. Capital allowance is now our business. Tax paid is our business. Tax refund is our business. In fact, the tax paid is not our business. Tax refund is our business, and what was lapsed. So this is how we deal with capital allowances carried backward. If you want to learn more about capital allowances, I will ask you to go and visit skills level taxation and learn more on capital allowances. Practice taxation in the skills level. What else can we take again on capital allowance? Let's see if there is any other question on capital allowance. Of course, the B here says determine the tax refundable by the FRS for the relevant year. So we have so this is your revised assessment. Total profit, tax payable, nil. Tax refundable is this. So we have done the two questions in one. Let's see if we can see any other tax question that has to do with capital allowance. This time it may not be carried backward. Most of these capital allowance question has to do with question number 1 down to I think we've done this question before. We've done something like this before. Let me check for a more recent question in skills level. Let's see whether capital allowances question will be included. Let's check if we will see capital allowance question. Is FR now. Okay, this question number 4. Let's see whether we can do something here. This is a 20 marks question. Compute the capital allowances. All right, so let's do this as the final question for today. As part of the induction program for the newly recruited staff of your firm of tax consultants, you have been saddled with the responsibility of making a presentation on company income tax computations for beginners during the firm's training session. You are provided with the following information relating to Wheezy Bado Limited, which commenced business on September 1, 2020. Okay, profit to December 2020. Of course, because they commenced business on September 1, so this is going to be from September 1, 2020 to 31st December 2020. September, October, November, December. This is 4 months. This is 4 months. And of course, this is year end. This is 12 months. Now look at these assets. Look at where they were bought. Then you were asked to state the basis period of for relevant for accessible period and qualifying capital expenditure. Okay, so what happened here is this period is going to be, because we see that the accounting year is always December 31st. They didn't tell you when the accounting year ends, but because they did it 2 times now and it's ending 31st December, we know it's 31st December. So this is year of assessment 2021, and this is year of assessment 2022. So we are going to be dealing with year of assessment 2021 and 2022 as our relevant year of assessment. So what we do now is, this is I need to put the I can pass question here. So let me go back to this. I will say this is November 2015. I say this is skills. November 2015, question 1. That's the first one we did. Second one we did here that we are doing now. This is I can pass question. I can pass question. This is May 2023. Question number 4, skills. So this is skills past question. So use it to learn capital allowances. So this is Wheezy Bado Limited. So I'll come here. Wheezy Bado Limited. Maybe they want to join Whiskey and Olamide, I don't know, Izibado. All right, it commenced business September 1. And question here is basis period for accessible profits and qualifying capital expenditure. So this is what we're going to do here now. A part, basis period for accessible profits and capital allowances. Okay, so this is the way we're going to do it here. We will start with year of assessment, basis period, accessible profits, basis period, capital allowance, and this is qualifying capital expenditure. So this is what we are going to do here. We'll bring it down, down, down. I must have you know that this is for the new tax rule, the new tax which is from Tax um, Finance Act 2019 upward, because here the company commenced in 2020. So we're applying the new finance rule. If it were to be the previous rule, you'll find out that the basis period for capital allowance and that of accessible profits will be different. And you will be seeing here that accessible profits will be having overlap and perhaps gap, but capital allowance will not have overlap nor gap, but they will not harmonize. The good thing here is that from the new Finance Act 2019, all the differences in gaps and overlap was taken care of. And so your accessible profit basis period is exactly the same as your capital allowance basis period. I'll take it again. From Finance Act 2019, the basis period for accessible profits is the same as the basis period for capital allowance, because the rule of capital allowance is there must never be gap nor overlap. And the law says whenever there is an overlap, the period of overlap belongs to the first period that it occurred. The period of overlap belongs to the first period that it occurred. When there is a gap, the period of gap belongs to the later period, unless we are dealing with the cessation rule, where the period of gap would belong to the earlier. All these are jargons when it comes to capital allowance during the regime before the Finance Act. This is because the accessible profit basis period will have contained overlap and gap. But for the new Finance Act 2019, all that has been cleared. And so the basis period of accessible profit will also go hand in hand with capital allowance. So this A part of the question, which is just 5 marks, is very easy. 5 marks is just too much. So we say it's 2021 and 2022. So you will say this is 2021. This is going to be September 1, 2020 to 31st December 2020. The same thing you are writing here. September 1, 2020 to 31st December 2020. Now the assets you are looking at are all the assets that was bought in 2020. We have land and building, motor vehicle, machinery. Land and building, motor vehicle, machinery. Rule the line. Then you go to 2022. That will be from January 1, 2021 down to 31st December 2021. The same thing for capital allowance. January 1, 2021 to 31st December 2021. So you check all the assets that were bought in 2021. We have furniture and delivery van. Furniture and delivery van. So that's it for that question. That question is done and dusted. The next thing in the question here is to compute the capital allowances. So you are not asked to find profits. You are not asked to find profit. This is just to compute capital allowances. So you need to just know that. Okay, so the B part of the question here, B, computation of capital allowances. Computation of capital allowances. So we have how many things here? Land and building, motor vehicle, machinery, furniture, delivery van will be under motor vehicle. So I will come here, I will arrange it this way. I will have my total figure here. Total capital allowance. I will call furniture and fittings F and F. F and F. Delivery van, I will join it with motor vehicle. Machinery, I will call it P and M. Plant and machinery. Motor vehicle, I'll call it MV. Motor vehicle. Then land and building, I'll say L and B. L and B. Alright, so we know the semantics I use here. So the next thing I'm going to do now is I'll put the initial allowance, initial allowance rate. Land and building is 15%. Motor vehicle is 50%. Plant and machinery is 50%. Furniture and fittings is 25%. You will be given annual allowance rate. This is going to give 10%. This is going to give me 25%. This is going to give me 25%. And this will be 20%. Of course, we have your investment allowance rate. Of course, okay, so I'll put my Naira sign here, Naira sign here, 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 and here. So we have just 2 years of assessment to do, 2021. So we have your year of assessment 2021. Basis period is September 1, 2020 to 31st December 2020. That is 4 months. All right. So you're just starting your business. So you start with costs of qualifying capital expenditure. The cost. Which assets did you buy? You buy land and building, motor vehicle, and machinery. Land and building is 5467,500. 5467,500. Motor vehicle is 10 million. This motor vehicle here, 10 million. And the next one here, machinery, 4,375,000. So of course your furniture, you didn't buy anything on furniture. So the next thing to do here is I can decide to take my investment allowance. Investment allowance is 10% of this. Now, even though it is affecting this, I'm not going to put it here. It's going to be on the capital allowance side. 10% of 4375 will give me 437,500. That's my investment allowance. Then I will come here to do my initial allowance. Your initial allowance for land and building is 15%. So what you do now is you look for 15%, 15 over 100 times 5,467,500. 5,467,500. That will give me 821.25. 821.25. Initial allowance of motor vehicle is 50%. That gives me 5 million. Then initial allowance of this will also give me 50%. So what's 50% of? So that's 50 over 100 times 4,375,000. That will give me 2187,500. Now, if you add all of this, that will give you your initial allowance figure. I have this on my calculator. I'll just simply add 5 million to it, and I will add 820,125. That will give me 8,007,625. So that's my initial allowance. So what do I have? I'll need to minus this to get a tax written down value. I have 5,467,500 minus 820,125. That will give me 4,647,375. I hope I wrote the right thing. 4,647,375. That's good. So this is my tax written down value. First of all, this will give me 5 million, and this will give me 2,187,500. Then my annual allowance here, annual allowance, now that's where things get interesting. Land and building, okay, why we didn't talk anything about initial allowance was because it is given out in full. You don't prorate. Investment allowance is also given out in full, no proration. Now you come to annual allowance. This was bought in June 5, but the business commenced in September. So it means that even though you bought it in June 5, you did not use it in the business until September 1. So you will take it that you will take it as though you bought it on September 1, because it's on September 1 that you put it to commercial use. So your annual allowance will start counting from September 1. The same thing in the one bought in July, it will start counting from September 1. So what we're going to do here, we say annual allowance will be tax written down value, which is this, divided by, okay, instead of me to say divided by, it's still the same thing like divided by the number of years. I'll do it in another way. I'll say times annual allowance rate divided by M over N. M is the number of months that it was used. N is the number of years in the basis period. I'll just say M over 12. So I'll take it as M over 12. So let's calculate the first one using this formula. We already have 4,647,375. Okay, that is our tax written down value. And we said that the annual allowance is 10%. I will say multiplied by 0.1. So this is the normal annual allowance for the year, which is this, right? But how many months was it put into use? This was put into use, this land and building, from September 1, 4 months. Put into use for 4 months. So you say multiplied by 4 divided by 12. So this is what we are going to take. I'm going to make it to the nearest whole number for the sake of this. 154,913. The same thing we are going to do here. We have 5 million multiplied by the annual allowance rate, which is 25%, so times 0.25, which is as good as saying divided by 4 years, anyone, that's 1,250. This is also used for 4 months, times 4 divided by 12. 416,667. 416,667. 416,667. And let's talk about this. We have 2,187,500 multiplied by this 25%, 0.25 times, how many months was it used? October. So October, November, December, 3 months. So you say this figure we just got now times 3 divided by 12. That will give me 136,719. 136,719. All right, so let's add them up together. 154,913 plus 416,667 plus 136,719. That will give me 708,299. So what are we calculating here now? We're going to calculate our capital allowance for the year. I already have the last figure on my calculator, so I will just add the initial allowance of 8,007,625 plus my investment allowance of 437,500. And that will give me 9153,424. So this is your total capital allowance. So the next year going to be year of assessment 2022. You can say your basis period will be from January 1, 2021 to 31st December 2021. All right, so the next thing here is to have your tax written down value. So your tax written down value it will be take this here 4,647,375 minus 154,913. That will give me 4,492,462. All right, so the next one will be 5,000,000 minus 416,667. That will give me 4,583,333. And this other one, the last one here, will be 2,187,500 minus 136,719. That will give me 20,50,781. And of course, this is dash here. So in this year, you also bought an asset, so you have costs of qualifying capital expenditure. What did you buy? You bought furniture for 3, 4, 5, 8,000. Then you also bought motor van for 750. Nothing was bought here, nothing was bought here. Okay, so because you have assets you bought, you will need to calculate initial allowance. Your initial allowance, this one will be dash because nothing was bought here. Here will be dash, nothing was bought. So these two items bought here, we need to find the initial allowance. Of course, this motor vehicle, this is 50%. So what we do here, we will say, let me use this other figure, 4750 times 0.5, which is 50%, 2375. Then we have here 3458,000. And this happens to be furniture and fittings is 25%. So I will look for 25% of it. So that will give me 864,500. So I'm going to add it now. I will add 2,375,000 to it. That will give me 3,239,500. 3,239,500. Sorry, I don't know why this thing keeps doing like this. Okay, all right. Now our annual allowance will be in two phases. Annual allowance, you will say for assets bought in year of assessment 2022. Year of assessment 2022. So for those ones bought in year 2022, which is these two, motor van and furniture and fittings, we'll treat them first. So how do we treat them? We treat them the way we have been treated. We treated the others when they were first put into use. So we'll say 4,750,000 minus 2,375,000. That will give me 2,375,000. Now, the annual allowance is 25%. And I will say times 0.25. This is the annual allowance for the year, right? But now, this motor vehicle, when was it bought? It was bought, motor vehicle was bought in May. So we're going to use it for 8 months because January to April it was not in use. So we're going to use it for 8 months, May to December. So what do? We will now say times 8 divided by 12. So that's the capital allowance for this one here, 395,833. So that's the one for here. Then this one, the second one will be we have 3,458,000 minus 864,500. That will give me this figure. And of course, furniture and fittings is 20%. So I will now say times 0.2. That will give me 5,187. This is the normal capital allowance for a year. So we'll ask ourselves, this furniture and fittings, when was it bought? In February. It was put into use in February, even though it's on the last day. It was used in February. So we'll give it for February. So it was used for 11 months. You now say times 11 divided by 12. 475,475. So this will give me 475,475. I'm going to add these two so that I will get the capital allowance in the same line. So I'll say plus 395,833. That will give me 871,308. 871,308. All right. Then the next thing we'll do here, we'll say for year of assessment 2021. So the one bought previous year. We just calculate the annual allowance. How did we calculate the annual allowance before? We'll go back and do it, but this time we will not be putting the number of years because the number of months, because this time now it has been used for 12 months. We'll go back again and say this is a tax written down value here, and that would be 4,647,375. But it's much better to do the cost minus initial allowance. Of course, when we do it, that's what we will get. Then we check how many years. It is 10 years, which is 10%. We now say times 0.1. Sorry, times 0.1. That will give me 464738. 464738. That's what I'll put down here. 464738. We also have something here. This is 5 million here. 5 million, right? And of course, it is 0.25 times 0.25. That will give me 1,250. That's what I'm going to put down here. And for the last one, we have something here. We have 218,700 and the same 0.25. That gives me 546,875. 546,875. We now add everything down here. Okay, just to be clear, I will put dash here, put dash here, and I'll put dash here. Just to be clear, I have this on my figure. I'll just put my 1,250,000 plus 464,738. That will give me 2261,613. All right, so we've done with the capital allowance. We'll now add everything together. I'll now add this 871,308 plus 32,39,500. That will give you 6,372,421. So with this, you've calculated your capital allowance. You can come and do something like this: year of assessment, basis period. This is not necessary. Then capital allowance. This is not necessary. This is 2021. This is 2022. This is September 1, 2020 to December 31st, 2020. This is January 1, 2021 to 31st December 2021. We know our capital allowance here to be 6,372,421. The other one here, 9,153,424. So that's it. That's the answer to this question. Now, assuming we are told to look for the tax liability, I'll just do that as a bonus. It was not required, but let's say you are asked to find the tax liability. So you simply come here, see computation of tax liabilities. I'll do it with this color. I will start with year of assessment 2021. You don't need to put your basis period anymore. Adjusted profit 69,37,500. Let me say 6937,500. I'll call it adjusted profit. And I'll say capital allowance. What's the capital allowance for that one here? Is 9 million. I'll come here. 9,153,424. Which kind of business is this people into? We are not told they have agriculture or manufacturing. So we are going to restrict your capital allowance to 2/3 of this. So you say capital allowance claimable. That would be 2/3 times 6,937,500. So that's what will be claimable. 6,937,500 times 2 divided by 3. So this is what you can claim. 4,625. 4,625,000. That's what you can claim. So what next do you do? Look for the capital allowance to be carried forward. I'll remove this from 9,153,424. So I have 4,528,424. So this is capital allowance carried forward. Then you have your total profits. Total profits will be 6,937,500 minus 4,625,000. That will give me 2,312,500. So you will now have your CIT at 30% of total profits. So you look for 30% of this. That will give me 693,750. And of course, your tertiary education tax will be at 2.5% for the year of assessment of adjusted profits. So you bring your 6,937,500 times 2.5 divided by 100. That will give me 173,438. 173,438. And that's for the first year. You now go to the second year, year of assessment 2022. No need to put the basis period. So you will start with your adjusted profits. How much is your adjusted profits given to you? 9,300,500. right? Then you have your capital capital allowance brought forward. This 4528,424 is brought forward, carried forward here to be brought forward to this year. 4528,424. Right? Then we have capital allowance for the year. How much did we calculate as our capital allowance for the year? 6372421. Okay, so this will be total capital allowance claimable. When we add these two together, what do we have? 4528,424 plus 6372421. That gives me 10,900,845. Then capital allowance relieved. Let me write the relieved well. Capital allowance relieved. Going to give me 2/3 of 9,300,500. So I'm going to look for 2/3 of that. 9,300,500 multiplied by 2 divided by 3. That will give me 6,200,333. So let's look at the capital allowance that will be carried forward minus 6,200,333. That will give me 4,700,512. So this is capital allowance carried forward. Then the next will be your total profits. You can also call it taxable profits, or you can call it chargeable profit. Any of these can go. We have 9,300,500 minus 6,200,333. That will give me 3,100,167. Then we have our CIT at 30% of taxable profit. So look at 30% of this, and that gives me 930,050. Then we have your tertiary education tax at 2.5% of adjusted profit. Adjusted profit happens to be 9,300,500. So we come here, 9,300,500. Yes, we look for 2.5% of it. That will give me 232,513. 232,513. So that's how you calculate your tax. So this was done as a bonus part so that when we'll be doing more about tax with capital allowances, you will be having enough practice experience to face the exam. So we've been talking about capital allowances, and we've looked at carry backward of capital allowance. You have to carry the capital allowance backward for 5 years from the year before the cessation year. Let me borrow the words used in the previous tax regime. The year that is the cessation year is usually called ultimate year. The year before the cessation year is called penultimate year. So it means if you are carrying backward, your penultimate year is the first year of carry back. That means the first year of carry back is the year before the cessation year. So that's when your first carry back year will begin. You take it down for 5 years. As the capital allowance are being utilized, you are carrying them backward up till maximum of 5 years. It's possible that it might be utilized maybe in the third year. Then there's no need to reach the 5 years. It's possible that you might utilize everything between the first and second carry back. Good for you. It's possible that at the 5th year you can utilize it all. Good for you. But if after the 5th year you can't utilize, the remainder is lost. The remainder will be lost. So that's it. Then we looked at normal capital allowances, how to compute capital allowances from commencement, and we did for 2 years because normally if they give you for 3 years, it's going to waste a lot of your time. So this has been capital allowance part 3. In our next class, we will take something called loss relief. Loss relief. So this is going to be building your knowledge up to where we'll be doing full-scale taxation question, where you'll be seeing capital allowances, loss relief, and taxable and tax liabilities. So, but the next topic is going to be on loss relief. So come prepared as we will have a good day in that class. So thank you very much, and I will see you again in the next class.